Hello, this is your daily dose of financial market trends. The AI boom might be hitting a reckoning. Tech investors are dumping chip stocks this morning as Wall Street starts asking a hard question. Are these companies actually making money on artificial intelligence or just spending it? Heading into this morning's session, yesterday's close showed a split market. The S&P 500 finished Monday essentially flat at 7,413, up just 7 basis points. The Dow gained nearly a full percent to close at 52,210, while the Nasdaq dropped 0.8% to 24,932, dragged down by tech weakness. The VIX ticked up to 19, and the 10-year Treasury yield fell to 4.64% as investors rotated into safety. Let's start with the tech wreckage. AMD is at the center of the storm, dropping more than 5% yesterday as this sector-wide valuation reset accelerates. The company reports earnings next week, and investors are clearly nervous that chip revenue growth won't justify the massive valuations these stocks have been carrying. Social media chatter shows real concern spreading beyond just professional investors. Microsoft is also catching attention, up nearly 2% yesterday, but facing the same scrutiny. The company reports tomorrow, and all eyes will be on whether their cloud and AI segments can show actual revenue conversion, not just infrastructure spending. This earnings call could set the tone for the entire sector. Apple is generating serious buzz ahead of its Wednesday earnings, climbing over 1% yesterday. Social discussion has spiked dramatically, and the stock is appearing across multiple market signals. Investors want to see how Apple is monetizing AI features in their ecosystem, especially as the company has been more cautious than competitors about overpromising on artificial intelligence. Then there's Robinhood, which has seen social mentions explode ahead of tomorrow's earnings report. The stock gained nearly 0.8% yesterday. As a retail trading platform, Robinhood's results will tell us whether individual investors are still actively trading through this volatile period, or if they're sitting on the sidelines. And we can't ignore ExxonMobil, down nearly 1.5% yesterday as oil prices cool. The US and Iran have paused direct military action, which is easing some of the supply risk premium that had been built into energy stocks. Exxon reports Friday, and the results will land in a very different oil price environment than seemed likely just weeks ago. 3 major macro scenarios are shaping market probabilities right now. First, those Middle East oil supply tensions. The US and Iran have paused attacks, causing oil to pull back from elevated levels. The bull case, at 35% probability, says if this pause becomes a real negotiation, oil keeps falling as risk premiums disappear. That would boost equities broadly through lower costs and reduced inflation pressure, though energy stocks would suffer from margin compression. The bear case, 25% likely, sees the pause collapse and military exchanges resume. Oil would spike on actual Strait of Hormuz transit risks, forcing central banks to stay restrictive. Energy stocks would surge, while growth stocks and consumer names would get crushed. Second, this AI chip sector valuation reset we've been discussing. The bull case at 40% says major players report strong AI revenue monetization in the next few weeks that actually justifies current prices. The sector rebounds as fundamentals meet valuations and institutional money flows back in. The bear case, 30% probability, sees continued disappointment where AI revenue can't keep pace with infrastructure spending. The sell-off deepens, momentum money exits, and tech contagion spreads broadly. Finally, Trump administration tariff implementation. Comprehensive trade barriers are being rebuilt, creating real uncertainty. The bull case, just 30% likely, treats tariffs as negotiating tools that result in deals with lower final rates. Yields stabilize, risk assets rally, and multinationals preserve margins. The bear case, 45%, and the most likely outcome, sees full tariff implementation without meaningful exemptions. Yields rise on sustained inflation expectations. Equity valuations compress, and companies with global supply chains face severe margin pressure and potential retaliation. On the housing front, 30-year mortgage rates have eased to 6.58%, down from a year ago, helping push existing home sales up nearly 3%. But inventory is building to over 9 months of supply, and home prices are growing at less than 1% annually. The market is normalizing, but activity remains weak by historical standards. This week is absolutely packed. Robinhood and Microsoft report tomorrow, followed by Apple and Amazon on Wednesday, then ExxonMobil Friday. These results will define how markets interpret both AI monetization and broader economic health. 5 things worth watching right now. First, tech earnings this week are make or break for the AI narrative. If revenue can't justify valuations, this sell-off has room to run. Second, the divergence between Dow's strength and Nasdaq weakness suggests rotation into value and defensives. That's a risk-off signal worth respecting. Third, energy stocks face a difficult setup with oil cooling just as they report earnings. The geopolitical premium is evaporating faster than many expected. Fourth, housing market normalization is real, with inventory building and price growth stalling. That has implications for home builders, mortgage originators, and consumer spending power. And fifth, tariff uncertainty remains the wild card. With implementation looking more likely than negotiation, companies with complex supply chains face genuine margin risk ahead. As always, this is educational content, not financial advice. Do your own research and consult a professional before making investment decisions. That's your Morning Market Digest for Tuesday, July 28th. We'll be back tomorrow morning with everything you need to know before the bell. Thanks for watching.